Exactly.
Good afternoon. We represent Whitworth University and are presenting our buy recommendation on Hecla Mining Company. We decided this recommendation due to Hecla's operational efficiency, competitive positioning, focus on exploration, and the future growth of metal prices. These factors drive our target price of $7.77, an upside of 30.2% from market close Friday, January 13th. Hecla was founded in 1891 and is headquartered in Coeur d'Alene, Idaho. Over the past 125 years, Hecla's management team has successfully navigated this difficult industry. Notice how Hecla's revenue is diversified by mine and also by metal. Looking at the graph to your left, I'd like to point out that although San Sebastian only constitutes 18% of revenue, this mine has successfully increased Hecla's free cash flow.
Hecla is a senior mining company. This means that they actually have operating mines. They also have a large portfolio of pre-development and exploration projects located throughout North America. Now, it's important for mining companies to have projects like this, due to the fact that less than 1% of potential mine sites actually end up getting developed. Hecla has 4 operating mines. Lucky Friday is primarily a silver mine. A new underground access point called the number 4 shaft was just completed and is expected to increase the life of the mine to 34 years, as well as give access to a higher grade of ore. Greens Creek is also primarily a silver mine. Recently, Hecla has been making investments here into automation, which have increased productivity by 15%. Casa Berardi is a gold mine. The East Mine Crown Pillar Pit is a new open pit operation that was just completed here and is expected to deliver roughly 25,000 gold ounces per year for the next 5 years. San Sebastian is a gold and silver mine. Now, as it currently stands, the San Sebastian project is only expected to last for 2 more years. However, the silver grades found here are roughly twice that of Greens Creek and Lucky Friday. Now, mining is a difficult industry. There's a global labor shortage, there are several permitting issues, and it's inherently cyclical. These are the average monthly prices of silver and gold. They tend to fluctuate within periods of 7 to 10 years. It is absolutely imperative for mining companies to be operating at full capacity in times of increasing metals prices as the reserves become more valuable.
Since 2006, Hecla has been strengthening its competitive positioning by growing reserves organically and through acquisition. Their reserve growth has also been less volatile than competitors due to the fact that they use the lowest metals prices to value their reserves, resulting in less asset write-downs. The chart on your left shows total CapEx spending between Hecla and their competitors. Please note that since 2013, Hecla has outspent their competitors on this metric as their management team saw value in investing in operations during this period. The chart on your right shows the capital intensity of the industry, with CapEx as a high percentage of revenue. As we mentioned earlier, mining is a difficult industry. This can be seen with Hecla and their competitors consistently having return on invested capital that is lower than their weighted average cost of capital. We believe that as Hecla has been investing in operations and producing assets during periods of depressed metals prices, we could see this trend reverse in the short to medium term. Cash cost after byproduct credits is the cost of generating revenues of the primary metals at mines after deducting revenues from the secondary metals. Hecla's constant outperformance on this metric is due to the fact that they have high-grade mines and favorable byproducts. Moving on to financial analysis. Speaking of their operational efficiency, in 2015, Hecla outperformed the industry on multiple metrics. In terms of their operating expenses as a percentage of revenue, it's important to note that Hecla's management team has better cost controls in periods of depressed metals prices than their competitors. In terms of liquidity, Hecla's cash conversion cycle suggests that their management team also has a better process of collecting cash. Their cash conversion cycle is 3.3 days compared to 95 days for competitors. This is important because it shows that Hecla has greater liquidity than competitors in a shorter period of time to finance inventories and receivables. In 2013, Hecla's debt-to-capital ratio increased to 28%. The increase was driven by a $500 million bond issuance to complete a debt equity purchase of Horizon Mines that gave Hecla Casa Berardi. We believe this speaks to the conviction of Hecla's management team to invest in operating assets during periods of depressed metals prices. In the last year, Hecla's interest coverage ratio has increased from just under 0 to 4.5 times.
Metal prices drive revenue in this industry. We knew that in order to accurately value Hecla, we'd also have to forecast these prices. We did this by taking the average of analyst estimates from Capital IQ, Bloomberg, and World Bank. Using these estimates, silver and gold prices are predicted to increase over the next 5 years from current spot price at 7% and 3% respectively. These increases are justified by our statistical analysis of key economic indicators. These graphs highlight that since silver is an industrial metal used in commercial products, its demand is positively correlated with economic growth. With demand for silver products growing annually at about 4%, and the labor participation rate stabilizing out, we believe that the economy will continue to grow along with metal prices over the next year. These assumptions come back into play in our final valuation.
The valuation methods that we used to write this kind of cash flow valuation valuing each of Hecla's 4 producing assets combined with the real options valuation on one of Hecla's non-producing assets. These are then weighted with the multiples valuation comparing Hecla relative to its peers. For the DCF, we valued each mine individually, calculating revenue, operating expenses, depreciation, and CapEx per mine. Additionally, we constructed base case, upside, and downside scenarios for each of these. Revenue in the forecasted period was calculated by multiplying together ore milled, grade of the metal, recovery rate, as well as the forecasted metals prices. Ore milled was modeled to capacity throughout the entire forecast period for every mine, with the exception of Casa Berardi. The grades and recovery rates were calculated by using historical averages as well as company guidance, increasing and decreasing per mine as per the respective ore bodies. And finally, the metals prices, as noted, are average analyst estimates. However, we did justify these trends through our statistical analysis. In the forecast period, the primary growth driver for Lucky Friday, growing at 7.2% compounded annually, is the addition of the number 4 shaft. Additionally, we did grow operating expenses by 4%. At Greens Creek, it grew relatively flat, only growing 1.29%, and this is due to the fact that it's already at capacity. Additionally, we decreased operating expenses because it is already running efficiently. At Casa Berardi, we increased ore milled to capacity by 2019, increasing it 40%, and the primary growth driver here is the addition of the EMCP pit. And at San Sebastian, the value driver is the very high ore grades. We modeled these at 30 ounces per ton. Additionally, we only valued San Sebastian through 2018 as it has a short mine life. Revenue in the aggregate period, aggregate revenue only remained relatively flat, growing 47 basis points. And this is primarily attributed to the loss of San Sebastian in 2019. We calculated the weighted average cost of capital. However, we did increase it 8% due to possible corporate governance shortcomings, which we discussed momentarily. In the terminal year, we used a growth rate of 1.5%, which is what we felt was conservative, and this resulted in a DCF target price of $5.62 using these weightings. In order to value Montanore, one of Hecla's non-producing assets in the pre-development phase, we utilized the real options valuation. The spot price represents 30% of the par value of the resources as they are classified as inferred, and the exercise price is the expected initial investment to get the mine operational. Using these inputs into the Black-Scholes options calculator, we valued Montanore at a real options value per share of $2.04. As of January 13th, Hecla was trading around our DCF target price. According to our valuation, we believe that the market is not assigning any value to Hecla for Montanore, which could potentially increase their reserves by 132%. According to our valuation, we believe that Hecla's intrinsic value is $7.66.
We utilized a Monte Carlo simulation to take into account the variability between grades and recovery rates at each mine. This is also how our model accounts for the possible widespread in metal prices in the future. Of our 100,000 trials, 60.5% supported our buy recommendation. Not surprisingly, silver and gold prices impacted our target price the most, with a combined sensitivity of 95%.
Along with the DCF and real option, we constructed a peers multiples model using 3 metrics: EV to reserves, EV to EBITDA, and price to cash flows. Using these 3 metrics, the implied price target is $8.04. When combining our 2 valuation techniques with their appropriate ratings, we have derived a final price target of $7.77. There are many risk factors to consider when evaluating Hecla, but 3 are extremely important to note. First, as mentioned earlier, there are some potential issues with the corporate governance structure of Hecla. Academic studies have shown that portfolios that buy firms with weak takeover protections and short firms with strong takeover protections generate an abnormal return of 10 to 15%. Because the measures taken by Hecla are not extreme, we have increased our discount rate by only 8%. Second, the profitability of Hecla is extremely dependent on the market price of gold and silver. If there is an extended period of metals price depression, Hecla will suffer financially. And finally, the exploration and process is extremely long and capital intensive. Because only 1% of mine sites are ever developed, these investments into these projects may prove to be fruitless.
In conclusion, Hecla's operational efficiency, competitive positioning, focus on exploration, and forecasted growth of metal prices derive our buy recommendation. Thank you. Now I would like to open up the discussion for questions.
So you guys were talking about corporate governance in terms of what exactly were you looking at on the corporate governance side? Were you looking at it from a total management and board standpoint in terms of comp as well, whether or not they're buying the stock themselves, and then as well some just the standard corporate governance they have, how it compares to industry peers?
The majority of the reason for increasing our discount rate was due to the staggered board of directors cycle. They have three seats up every year, and it could take potentially 3 years to get all of the sitting board members off if you wish to take an activist position. In terms of the executives, there is a disparity between the CEO pay and all others.
Did you look at that in comparison to peers in the industry to see that that was in line practice, or was that normal?
We did not.
So you mentioned with your DCF that San Sebastian, you only had, what, 24 months? What did you use for terminal evaluate or your terminal growth rates for the other mines, since at some point they'll run out as well?
The terminal growth rate was 1.5%, and that was just on the final year of cash flows. And it was taken on the aggregate of the cash flows combined.
Okay.
So the terminal growth rate was after we combined the cash flows.
So you didn't look at mine lives for each individual mine, you just did it for San Sebastian?
Yeah, the other mines have mine lives of greater than 10 years.
Did you guys run any type of stress testing or analysis in terms of, obviously this particular company has a very high delta to the commodity prices. So if gold goes to $1,800 or $800, at what level they're basically at break even, and then, you know, big upside or potentially big downside based on the potential volatility of commodities?
Yes, we did. We took into account potentially going down 25% from our projected prices, and the DCF, if both gold and silver are 25% lower than we project them to be, the DCF target price drops down to $1.87. We did that with the real option as well, and coming down 10%, the real option value drops from over $2 to $1.74.
Did you do any upside analysis?
For the real options, yes. If it goes up, it could potentially be, if it goes up to 10%, it could potentially, the real option is worth $2.35. We did not do the upside analysis. It was more of a worst case scenario.
Okay.
So for your upside case for the DCF, you put a 25% increase to the commodity prices?
No, that was just for a sensitivity analysis.
Okay, so because you talked about you had an upside base case and downside case, what were your differences in assumptions there?
So the difference in assumptions there were grade and recovery rates.
Okay.
So those were specifically the process of extraction.
Yeah, each case, so for instance, like on Friday upside, the upside grade rates in the analysis, they would have a different range than say the base case, and in the downside case, each are kind of centered around that mean.
Okay.
And go from there.
Did you guys do any peer analysis in terms of where they're trading on price to sales, price to cash flow relative to other comps in terms of like a Pan American Silver or somebody else that's either just in the gold and silver space or in particular companies that have a particular high exposure to silver?
Yes, we did that with our multiples valuation using the EV to EBITDA, EV to reserves, and price to cash flow.
So ESG, environmental social governance based investing, is a pretty big theme in the industry, at least institutional investing where I work. How does Hecla rate compare to peers in the mining industry, since that's an industry that's kind of got a target on in ESG circles?
Hecla has a good history, environmentally speaking. We point to Montanore as being the biggest focus of this. Currently, it's taken the permitting process with the Additional Environmental Assessment Policy Act has taken about 25 years, and so they've definitely taken their time with this. And relative to peers, I don't know anything specifically, but Hecla itself does have an excellent track record, environmentally speaking.
Have you guys looked at all in terms of the new Trump administration, in terms of potential policy changes, how that can impact the business going forward?
Yeah, so there is a proposed border tax between Mexico and the United States. However, the process from San Sebastian, it goes from San Sebastian to ore, and then it goes to smelting, and then it comes back to the U.S. So we don't believe that that border tax is going to be much of an issue for them. And furthermore, we haven't seen anything in the news about Hecla coming out and saying this is an issue. We haven't seen many analysts assessing risk to that. So until we see that start showing up and we see the executives saying this could be an issue, we don't see that as affecting our target price at this point.
So do they just, so I'm clear, do they hedge their commodities at all?
Yes, they do. Mainly zinc and lead. They have forwards contracts for 2016 and 2017, and 2017 now. The majority of their gold and silver exposure is left unhedged, except from point of sale to the actual final purchaser, just to account for potential small fluctuations in metals prices.
And they just roll those hedges going forward?
Yes.
Can you maybe compare and contrast a little why an investor would want to invest in Hecla or mining versus the commodities themselves, silver and gold?
Yeah, so it's a really good question. The way we would interpret that is we trust that Hecla's management team, based on what we've seen them do over the last few years, is invest in the producing assets and invest in their operations during a period of depressed metals prices. And they have a great, they have 40% from gold, 40% from silvers. So they're very well diverse in terms of silver and gold. So while that might be an option for investors, we definitely see Hecla as a equally as good option to the individual metals.
I would also like to add that I think Hecla is also a less volatile option than just investing in the individual metals, just because there's other factors going into their mines and things like that. So I would argue that it's a little less, you have less risk by investing in Hecla directly.
You also mentioned that you felt management was overly conservative in pricing their reserves. At your guys' idea of fair market value, how much more would the company be worth than if they're showing in the book right now?
I don't think we don't have that direct answer for you, but where we've seen that show up is in the impairment on their income statements compared to competitors. So they're one of the three companies that we compared them to that haven't written down their assets or written down their mines as gold and silver have dropped. So they've been conservative in that. I don't have a direct answer for you though.
Do you know what commodity prices they're using right now to value those reserves? I can look it up.
Yeah, for now.
Yeah.
They tend to use lower end of the spectrum for the commodity
So they've been
prices.
pretty conservative.
Right, that's what they've been doing.
Yeah, for 2015 for silver, for instance, they use 1450.
Right, which is it's trading right now at 1754.
Did you guys take a look at M&A in the sector at all? Whether Hecla was active versus its peers and if those acquisitions have gone well?
Yeah, so in 2013, it was June, they acquired Casperardi. That was at 35-month lows in gold prices. So as far as that compared to that period to where we're at now, we see that as a success. We don't have that compared to the industry as a whole. Another area that we've seen growth is in 2008, 70% purchase of Greens Creek. Yeah, Greens Creek. And that helps spur their reserve growth from where it was at in 2006. So, and as we mentioned, that's helped strengthen their competitive position since then.
And then to add on to that, the acquisition of Mines Management, which owned Montnor, was in September of this last year. And so that we believe as part of our crucial to our valuation, and that we don't think the market has valued that. So we see that as a growth potential for Hecla because potentially it would grow the reserves by 132%.